In this video, we will learn how to quickly and correctly identify the business cycle stage in order to gain perspective on the market and not be misled by sources that has a conflict of interest with us, such as TV forecasters and fake educators. The term bull market comes from the movement of a bull during the attacking of its prey, in which it moves its horns upward. A bull market is characterized by confidence and optimism that the economy will do well over an extended period of time. It is defined as the rise of the index above the bear market level. Consumers stop saving and start spending. GDP results and hence corporate profits become positive. A bear market is the opposite of a bull market, in that pessimism drives a downward spiral of the financial markets. It is named after the attack of a bear swiping its paws down. It is defined as 20% fall in an index from its year or 52-week high. During a bear market, traders short the market in anticipation of bad financial results and contraction of GDP and hence the economy. If we look at the S&P 500 from 2006 to 2010, we can see that it was in a bull cycle and the financial crisis of 2008 happened and the market entered the bear cycle, and then it rebounded and the cycle turned into a bull again. So this is the secret that every trader should know. You want to learn how to identify a bull or a bear market and trade accordingly. If you do this, you can simply make money. In 17th of October of 2007, the S&P reached an all-time high at the time, which was 1541.23, and the bear market was 1232.98, which was reached in 15th of July of 2008, right about here. There was a small rebound, a small rally, and then the market crashed. So every trader in this zone was aware that something was wrong, every professional trader. And when they saw this mark being crossed, this bear level, everybody positioned themselves to short the market. And this is the time of a bull market where everything goes down, like we have talked about in previous videos. Here, if you long the market, you'll be losing lots of money because the market will be gradually going down. And we can see this happening when we look at the S&P from the period of 2006 to 2010. Now the question here is, how long will the stock market remain in this bear cycle? This is also another thing that retail traders should learn. And when you're able to identify the levels of bear and bull, you will be able to trade correctly. We can see here that the S&P reached an all-time low, or a low, which was 676.53. This was the close of the S&P in the 9th of March of 2009. And from here, the market rebounded. You can see here that the bull level is 811.23, which was reached in 8th of April of 2009. Now here, if you start shorting the market here, anticipating that the market will go down again, you will be losing a lot of money. What all professional traders did around this time is long the market. They did their analysis and they started longing the market right about here. This would have been a very, very nice entry for you to enter and buy the market. So in the period of 2006 to 2010, we can see that the market was in a bull cycle and it crashed and entered the bear, and then it rebounded and became a bull market again. Now if we look at the S&P from 2009 until present, we can see that this is where I was mentioning in the previous slide. If you've entered and bought the market right around here, you would have made a fortune, because this recent bull cycle has continued for about 10 years now, and that is a long bull cycle. What professional traders do is identify stocks which will outperform in a bull market, right? So let's assume we take the example of Apple. In May 1st of 2009, Apple was trading at 12.17, and in September 14th of 2018, Apple was trading at 223.06. Now, if you have invested $10,000 and leveraged it 5 times in May 1st of 2009 and bought Apple, your outlay would have been $861,471.09. That is 86 times return on your initial investment in just 9 years. Now, this is how professional traders trade. They don't trade daily because these types of returns cannot be made in a single day. And this $10,000 is not what they invest. They invest a lot more, and that is why they make their huge sums of money. We, as retail traders, want to identify the market in order to gain perspective. This is the first step toward our goal of staying consistently profitable. We don't want to be short when we have prolonged periods of strong market performance, and we don't want to be long during weak market performance. I hope this video has helped you understand the difference between a bear and bull market, and taught you how to gain perspective and read the current market conditions correctly. In the next video, I'll show you, using Excel, how to freely get the available data about the indices and use Excel to correctly identify the economic business cycle stage. Please like the video if you found it helpful, and subscribe so that you don't miss upcoming videos. Thank you very much for watching. I'm looking forward to seeing you in the next video.